What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie and Charlie with you today. No Ben this week. Unfortunately, he's not feeling very well, so we've sent him at home.
Yep.
Don't give us the lurgy.
Absolutely not.
But get better soon, Ben. But we can do it all today, Charlie, because you and I have been so busy this week on the news.
We've been powering through it, and a lot has happened for just a week. I know we say that every week,
Yeah.
But especially the last month, we've been cramming a lot of content, whether it be rates or the budget.
The budget.
Into single weeks.
Yeah.
So looking forward to unpacking it.
Yeah. Lots in the budget this year for us. The speech started at 7:30. The documents come out. All the journalists of Momentum just frantically pulling apart millions and millions of pages. You know, it feels like millions at least, like thousands of pages, looking at what's relevant for us. But in housing, quite a lot. Now, thankfully, a lot of it was teased ahead of time. So we knew something was going to be coming with
fresh.
CGT and negative gearing. But these are the big ones for housing tax. One of the biggest changes in housing tax reforms in recent years, probably since negative gearing pretty much came into being, looking at changing it all to try and make it more fair for younger home buyers and, of course, the growing voting population as well, or kind of the younger generation. So trying to look at make it more equitable for different generations to buy. And a lot of the conversations that we heard from Treasurer Jim Chalmers ahead of his speech on Tuesday was about intergenerational inequity and trying to make it equity. And the solution, they're saying, is basically reducing the amount of speculative investing by changing the tax treatments so that they're not so favourable. Now, anyone who has been obviously following this, I think everyone read that story on Tuesday evening. But if you haven't and you haven't yet seen it, surprise, there are negative gearing and capital gains tax changes coming up. Now, they're not immediate. So we have some time. But let's kind of give you the headlines. Basically, from if you bought a property before the budget speech started, so from 7:29 p.m. on the 12th of May, 2026, if you already had a property, you can still continue to negatively gear. Otherwise, you can only do it for new dwellings. And the other big one is replacing the 50% capital gains tax discount for established dwellings with an inflation-adjusted indexation method from the 1st of July next year with a 30% minimum tax on net capital gains. So two big changes there.
Massive reforms.
And, you know, I think a lot of what Jim Chalmers was saying was that really it's about trying to free up some stock for first-time buyers and make it less attractive for investors to be buying established dwellings, making them look more at the new builds. And that's why there are these carve-outs for new builds.
100%.
What do you think, Charlie?
Well, ever since I've been invested in, Australian politics, these two policies and issues where, capital gains discount and negative gearing have just been massive talking points for all of the parties. And they've all got very conflicting kind of opinions on it. But they are massive reforms because, Labor didn't take it to the election and now they're in the budget. And capital gains tax especially, that hasn't been grandfathered, unlike negative gearing as well. So it's an even bigger step than they've gone on negative gearing. So I think they're going to have ramifications, and we'll see how that impacts investor demand if it drops off, or if it takes a bit of time to kick in. If it's more kind of instantaneous shock, and then it maybe recovers, or if it's kind of gradual over the next 1 to 5 years, and they're projecting it out to 10 years as well. I think they've got those 75,000 new first home buyers.
Well, this is what they say.
These are all on forecasts as well.
I also don't understand where they've got that figure from. I went through the budget papers because they keep saying 75,000.
That's the stat that they're using,
houses will be created over the next decade. Which actually is not that much, considering that we need 1.2 in the next 4 years.
If you look at how much...
1.2 million, I should say.
Kind of housing economists are saying how many houses need to be built in quarter and on quarterly basis, 75,000 over 10 years.
Over 10 years, not that many.
No, it's not.
So that is one thing. And the other thing that I thought was really interesting when I was looking through the budget documents was talking about they actually think that there'd be 35,000 fewer houses than if they hadn't made these changes. That's not a huge amount.
It's quite modest.
But I will read what the budget papers read, because I thought this is the main crux of why they're doing it, because that, of course, is the question.
Yep.
And this is what it says. The 50% capital gains tax discount and negative gearing provide generous incentives for investors, which have added to demand for property and contributed to higher housing prices over time. This has come at the expense of owner-occupiers, making it harder for more Australians to own their own home. These tax settings distort investment towards more leveraged investment in existing homes and are poorly targeted when it comes to supporting new housing supply. The 50% discount also poorly approximates the inflation component of returns, meaning investors can be undercompensated or overcompensated for inflation across a range of asset types. Now, they're saying that based on this, housing prices will temporarily grow by 4% over a couple of years, which is 2% less than it would have been without these changes. They're saying basically it's a 2% house price change as a result.
Yeah.
And they think that means that a buyer purchasing a home at the current national median price would save around $19,000.
Yeah.
But the question, as everyone is talking about, is being like, well, how on earth is this going to help anything? Because surely we don't see a huge sort of rush of people selling their properties. But we have yet. It's only been a few days. Still got to see what happens.
Exactly. And I think those reductions to home growth statistics are interesting, because we saw that in all
price growth,
in the bank's kind of commentary as well. They've said, well, look, in our forecast, we're now factoring in a lower growth rate due to these reforms as well. And current, you see in those monthly APRA ADI statistics, and also in the lending indicators that we get from the ABS, that investment activity for quite a while has been outpacing owner-occupier. And those high growth rates in a lot of the capitals, not so much now Sydney and Melbourne, but some of the mid-sized capitals are being propped up by investor activity.
Yeah.
And it's way above owner-occupier. So I think it's going to have an impact, very much so in the short term, as people kind of, adjust the changes, see how they're impacted by them. But, existing investors still have the ability to negatively gear. I think it's going to be the impact
for new builds,
for new builds, but they can still negatively gear on existing properties.
Oh, they already owned, yeah.
Yeah, exactly. Yeah. So I think the impact
is
going to be
as long as they own them before budget night.
True. So the impact will be on CGT, I think, for that cohort as opposed to negative gearing. But I don't think the government seems to mind much that there's going to be lower home growth rates moving forward.
Yeah, well, I think the main thing for the government is saying, cynically, you can say this is all just because they want more money, which sure they do. So it's just kind of being like, they do obviously want some more money coming in. Yeah. So the cynics are saying this is basically a cash grab and they want some more money. But I feel like most people I've spoken to who are not high net worth individuals or are not sophisticated property investors are generally like, okay, that sounds fair.
Yeah, unfazed. And also,
against your personal income.
Younger generations as well. It's a controversial concept that, property investors can deduct rental losses off their income.
Yeah.
And that's kind of being offset by everyone else's kind of income taxes as well. So
and this is
it's
again
contentious. It really is contentious stuff.
Yeah, the Treasury was sort of saying is like, it's really providing an incentive to tax investors that working Australians can't access. They can't get this benefit. So it kind of is skewing it that way. And that's why Australia is crazy about property.
Yes.
But we already know one of the big things that will be coming off the back of this, and we're seeing it already, is a huge demand for broker services, accounting services, financial planning services. Basically, financial services are going to be absolutely inundated and are already.
Especially with those trust changes as well.
Exactly. Lots of people being like, what does this mean for my portfolio? What does this mean for my borrowing capacity? What does this mean for my retirement plans?
Yeah.
What does this mean for my trusts? Can I still buy in trust? What does it mean for the new tax changes and discretionary trusts. Lots and lots of different questions being asked and people doing the sums. I actually spoke to a few brokers for our sister title broker Daily about this. And one of them, Costa, who is a broker at Finney, was saying he had talked to someone whose borrowing capacity had dropped by $166,000 as a result of these changes.
Whoa.
But of course, that is someone who is a sophisticated investor.
True.
So yes, there's going to be lots of tightening going on, but really where the government wants it to be happening and hoping that that means there will be more properties put on market and that first home buyers can come in and have more supply from established dwellings rather than having to wait for a new build.
Exactly.
But I think the main criticism we've been hearing from people is saying, where is all the supply in this? There's only one real big initiative that was announced to help supply, and this was $2 billion to help with the infrastructure, connecting housing to things like roads and sewer works and power, which is obviously really needed. And a lot of the local government areas that have been building housing developments have come under a lot of fire for creating these sort of ghost cities that are set up and they're promising to have, power and water and electricity and schools and hospitals, and then none of those things happen.
And
so people are just literally, got an empty house waiting to move into, but there's nothing connected to it.
Yep.
So an extra $2 billion to support the connection of all those things, which they suggest could unlock up to 65,000 new homes. That would be great.
Over what period is that?
That's a great question. I think it's 10 years.
Okay.
But I'll have to double check. And then also looking at sort of accelerating some of the approval times and the environmental approval times, working with the states again, because of course approvals and planning is all mostly state-based.
Yep.
So trying to work more quickly with them. The other thing they were talking about, though, to encourage to free up some more stock was to extend the ban on foreign investors buying existing homes. So that's going to now go until 2029, mid-2029. So that, again, should help sort of ease some of the pressure off so that we don't have people who want to buy a home and live in it not being able to.
Yep.
And that was the big conversation that Jim Chalmers and Prime Minister Anthony Albanese and the Housing Minister Claire O'Neill were talking about. For the first time this year, they were teasing it on social media. On my way home to do the coverage for the budget, I was like, oh, there's a little tease here. They're like doing some sort of Instagram and LinkedIn videos.
Yeah, I saw that.
Yeah, and I was
which
like,
is really rare for them
reshare.
to be doing that too. Usually it's just black silence for that 5-hour period before it's handed down.
A little tease. I think it was like, I don't know, 4 o'clock, 5 o'clock, something like that. And I was a bit like, oh, this is interesting. They've put this out on socials before they've announced
a
what
lot
they're
of
doing.
conventions dashed this year.
Yeah.
I think.
And of course, the budget supply is also held this week. So
budget reply.
That's what I said.
By opposition.
Budget supply, I just said. Yeah. The budget reply.
A lot of talk about supply.
Has obviously come out. And shocker or not, they've been like, we don't agree. Which obviously the opposition is always going to say. And I think this is, again, lots of people criticising the government for saying, you said you weren't going to touch CGT and negative gearing. What happened? And their answer so far has been like, things have changed. Basically being like, well, we did say that. But, in the past, Labour has looked at this and kind of been like, well, also, the Middle Eastern conflict has been a big core focus. They've kind of been like, things have changed. Sorry about that. Well, mea culpa.
Yeah, I think I saw Jim Chalmers' interview with Sarah Ferguson immediately after the budget was handed down.
Yeah.
She was pressing him most on, well, what specifically has changed?
Yeah.
And it's a hard point for them to answer, I think, because, you've got the conflict, but, it's a little bit...
changed property investing.
Exactly. It's a little bit tenuous to draw a direct link between a conflict in Iran and property prices in Australia too. So... but again, I think the government's pretty unfazed here. They've got a supermajority in the House of Reps and, pretty solid numbers in the Senate. So
yeah, and
I don't think they mind.
They don't mind. And this is the fifth one they've handed down. So they're kind of like, we kind of know what the reaction was for the last few. Let's see what happens this time around. So I think generally they're kind of talking about the housing was the main thing for us, obviously. And I think for most people, housing were the big changes. There were obviously lots of other things, a tax cut for every working Australian. There was the instant asset write-off as well, being made permanent. I cannot get my words right today.
That's all right. There's a lot of words to process here.
It's been a long week. It's been a lot of hours logged in this week. Instant asset write-off being made permanent. So for anyone who's been following along, you might remember the legislation is for an instant asset write-off of $1,000, and every year they have to redo the legislation to be like, actually, we want it to be higher. So during COVID, it was massive. It was like $150,000.
Yeah.
Then it dropped down, and now it's $20,000. And so each year they've kind of been having to redo the legislation to make this $20,000 extend for another year.
Exactly.
So this time they've been like, we're just going to make that permanent because this is a waste of time.
Yeah.
In effect. And it
And
gives
it's popular
borrowers,
too.
and it's super popular with small businesses. It gives them much more certainty. They can invest and have their write-off there. So it's $20,000 and it's per asset. So you can use it multiple times.
Yep.
And it's for businesses with a turnover under 10 mil.
Under 10 mil, yeah.
So they're saying, well, you can deduct the full cost of these eligible assets up to 20 grand. So that makes lots of people happy in the small business space.
Yep.
A lot of the small business lenders I talked to as well this week. So Banjo Loans, Prosper, Scott Pack, and Westpac as well, actually. I talked to as well about this. And they were sort of saying, well, we really love the interest asset write-off being made permanent. We would have liked to have seen a few more things for small businesses, but generally they're kind of like, not a bad budget for small businesses. Not a great one either.
Yep.
Meh.
Mixed feelings.
Yeah.
Yeah, mixed feelings. I think, it was a positive thing that the government landed on a definitive position on this, because uncertainty, especially with small business at a time like this, it's not preferred. And all of the commentary that I've seen from advocacy groups, but also small business bodies are basically overwhelmingly welcoming this. And it does make a difference. I think very much so.
The big thing now, I think, is, well, what does this all mean for what the status quo is, and what does it mean for lending? And we had already some interesting commentary coming through from some of the lenders being like, we think there'll be some changes in the way that people are borrowing. So maybe SMSF lending will get really much bigger than it currently is, or potentially much more sort of tight around who's actually borrowing an SMSF.
Yeah.
You were doing some commentary for the advisor from Barry Saud at Pepper Money, who was talking about this. What did he have to say?
So, like you said, it was interesting to see how he thinks it's going to impact kind of demand for certain loans and whatnot. And he basically said that, for some investors, it means that, with these changes coming in, they might be looking beyond ownership and becoming familiar with other types of prospects. And he touted companies and trusts, but like you said, self-made super, especially. And he kind of said that, while it remains a smaller cohort, it's going to become the largest of the smaller domain type of lending he foresees. So SMSF property investing in particular, he thinks is going to be attractive moving forward for investors, but a smaller group, as you said, of sophisticated investors, primarily due to the fact that it operates under more or less favorable tax settings. But he said, sure, it's a specialist it remains a specialist strategy, and it comes with, compliance requirements and so on. But I think he advised brokers to familiarize themselves with self-managed super, and the settings required, the logistics, the details, because he thinks there's going to be a kind of influx of inquiries for that.
Yeah, I think those are the kind of the big themes, aren't they? Saying SMSF surge potentially because of the result of the housing tax changes, and also new build surge. So lots more interest in house and land type packages and new build renovation, construction.
100%. So he thinks that because of those carve-outs, that, like you said, new builds and construction will emerge, he thinks, as a, quote, clear opportunity. And you've got those additional investments from the government on the supply side as well.
And most of the aggregators as well that came out in reaction to the budget pretty much was saying that. Nearly all of them, I think we spoke to Connective, Finsure, AFG, Loan Market, who else? There was a lot of them.
Yeah.
A lot of the major aggregators came out to respond. I think some of the economists from REA Group as well were talking about this, and they were saying, new build will obviously be a big focus. First-time buyer activity will probably pick up again. Investor activity will be super strong in terms of looking at refinancing or restructuring. So brokers will be looking at that. SMSF was the big one. I did think, though, the comments from David Bailey at AFG were really interesting because he was probably the most opinionated of all the aggregators. Most of them were saying brokers are going to be super busy because everyone's going to need some help understanding what these mean for them and understanding what the borrowing means for them. But this is what David Bailey said, and I thought this was interesting. He's like, AFG would be cautious about assuming the negative gearing delivers a meaningful supply uplift on its own. New housing remains constrained by planning, infrastructure, labour shortages, construction costs and finance conditions.
Yep.
There's also a risk that investors crowd into a narrower new build segment, pushing up prices there rather than materially increasing total supply. Younger buyers need more homes, better access to credit, and greater confidence in long-term affordability. Reducing investor participation may ease competition in some segments in the short term, but it also weakens rental supply or construction activity. But if it also weakens rental supply or construction activity, the affordability challenge simply reappears elsewhere.
Those are some really good comments.
Yeah, I was like, those are good for you, David, having an opinion. And he was actually sort of talking about, and the other thing he was worried about was CGT not just focusing on residential property, but also applying the reforms to shares, commercial assets and small business interests, which he's like, that might impact investment. And he's like, that really matters because small businesses they rely on capital. They are risk-taking, they rely on asset investment. And he's like, if you somehow shift this, that will impact that too.
Yeah, I've seen an influx of commentary in regard to, not having maybe specific carve-outs for, like you said, commercial property or shares, or maybe specific type of shares for venture capital or startups and someone that might be hit the hardest because they're younger and they don't have the duration maybe as other established companies do to recover and recoup that. So, yeah, really good points. And, yeah, I think that overcrowding element in the new build is really interesting because obviously the government wants to incentivize new supply as much as possible.
Give us some more builders.
Dangling the carrot in front of the investors to do that probably have the disposable capital to do that, unlike, first home buyers. However, we've seen it with the 5% deposit scheme because of putting so much demand online, lower price segments have skyrocketed.
Yeah.
So the same might happen in new builds. And also the brokers that I've been speaking to are basically saying that, because of the price caps, the difference between the market price and the price caps on that scheme, first home buyers are looking at land packages now because it's all they can kind of afford.
Yeah, but then they're waiting years for a house to be built.
Well, exactly. And now with these changes, they might have even more competition, which is the last thing they need.
And of course, the question as well, the concerns about rents going up is if, investors are having to no longer negatively gear, they're like, well, how am I actually covering my actual costs? I'm going to have to put the rent up.
Yeah, well, I can no longer deduct it off my income tax. So
exactly. So lots of interesting unintended consequences, although of course I'm sure Treasury would have looked at this, but I think it's always really interesting reading the Treasury analysis. So obviously the budget paper measures number 2 is where the actual measures are. Budget paper number 1 is the one where they actually talk about why.
Yeah.
So having to have a read through that if you're interested. It's really interesting. Yeah. Some great bedtime reading for you. But obviously that's, I think, the big thing. And then going up into the next election, I don't think this will be a linchpin for swinging votes either way.
Yeah.
But if they can do something about supply, now that might do.
Possibly. Yeah. I feel like people have got fixed opinions on this.
Yeah. And I think, again, our sister titles on property smart property investment, who deal specifically with investors, well, obviously had a lot to say about this. Yeah. We actually released a podcast that they did a live stream earlier this week following the budget, talking about what this impact was. It was with Momentum Media Director and avid property investor Phil Tarrant, our colleague over on Real Estate Titles Liam Garman, and real estate coach and commentator Tom Panos, and they had a great chat, a really heated chat about what they thought about all the changes. So if you are interested in the investor angle, we've released that on the Advisor Podcast Network channel too, so you can go and have a listen to that.
Awesome.
From earlier this week. We'll take a quick break here though, because that's not everything that's been happening this week. It's been loads. You've been to court this week, Charlie.
I did, yep.
We'll get into that just after this message. So this week we had some drama in the courtroom unpacking, and Charlie, you went down to, is it the Supreme Court?
Supreme Court.
Yeah, to see what was happening. And this is the ongoing stoush between Hai Money and Finsure about their aggregation agreements.
Yeah.
Now, for anyone who's not been paying attention, Charlie, give us the headlines. What exactly was this focused on?
So as you said, this is obviously related to Finsure in late April deciding or moving to terminate its sub-aggregation agreement with Hai Money, which has only been in operation for about a year and a half. And this all kind of sparked from red flags about potential broker misconduct within the Hai Money network. And this has left, 200 brokers effectively frozen out of major lending kind of systems. But yep, I went to court this week. This week.
To watch it, not to be in front of the court. Yeah.
No, absolutely not. Thank God. To spectate and report. So Hai Money has brought an injunction against Finsure to basically overturn this termination and asking the Supreme Court to return the agreement to its status quo before the termination. So a lot of arguments presented from the Hai Money Legal Counsel, some pretty technical arguments from them. They kind of started on definitions. I thought this was really interesting for someone who doesn't go to court much.
The amount of contract, contract law that you have to.
But this was actually interesting. They kind of emphasize that the contract defines aggregators and sub-aggregators as intermediaries between brokers and lenders. However, they said that Finsure's interpretation of that was too narrow, and that it shifted all of the kind of consequences of broker misconduct onto Hai Money, and that only seeing sub-aggregators as an intermediary without including brokers wasn't correct in their view. They protested that.
So I think the big thing, obviously, for anyone who hasn't read this story previously, they dropped them because of lenders flagging alleged misconduct. And Hai Money last year
terminated.
Thank you. That's the word.
14 brokers. They terminated 14 brokers from its network in December.
As a result of alleged concerns with misconduct. And then over that time, since then, there have been some of the major lenders have said, well, we've been looking at this and we've been actually deciding we don't want to be working with this aggregation group anymore, from what I understand. And so therefore they cut ties. And then Finsure basically said, well, if you're not able to access major lenders, that really fundamentally undermines your business. We don't think we want to be giving you sub-aggregation agreements. They terminated. Now, this has caused all kinds of trouble for all the brokers who were operating under them who haven't been alleged to have done anything wrong.
No.
And who haven't been, wrapped up in this penthouse syndicate mortgage fraud case that's been going on as well. So lots of brokers
which
kind of
they
being
believe this is more
related
or less connected to.
Yes. So I think there's lots of brokers being like, well, if Hai Money is no longer in existence, we no longer have an aggregator. It's very hard for us to find someone who will take us on if we can't access these major lenders because they've dropped us. So bit of a pickle.
Yeah, very much so. And that came up a lot in court as well, that a lot of these brokers that have not committed wrongdoing have been left high and dry, and really don't have
high and dry.
No pun intended. And don't have anywhere else to go. And obviously, this is a result, as you said, and we found out definitively in court that NAB did indeed move to suspend the accreditation of all Hai Money brokers, and due to fraud concerns with specific brokers, but.
I think it sounds like they're concerned with the compliance. If they're saying, they're not worried about everyone in Hai Money having committed fraud, what they're saying is, I think, from what I understand, is they're kind of saying, well, if there were always brokers who were found to have done the wrong thing and committed misconduct, we want to see what compliance checks were done, and basically being like, we don't trust the compliance checks. That's what I think they're saying. But I wasn't in court, and I haven't talked to NAB, so who knows? I could be completely wrong. I'm just guessing there.
It was also on the basis of association too, which might sound a bit cruel, but documentation was read out from NAB justifying why some of these, and it only started as specific brokers, were terminated, accreditation were terminated, and they put it down to fraud concerns. But later, when they moved to terminate all broker accreditation, they put that down as association. So, if the network has allowed, as you said, a broker who was faced charges over potential fraud, then we're just going to one and all rule type of thing from the banks.
We don't trust the compliance,
No.
The sort of oversight. So I think this is really interesting. And now the battle will continue on because it didn't conclude this week in court, but you went along to have a listen to the arguments, learn some more legal jargon, I think, as well from the lawyers.
Yeah, absolutely.
But really interesting to see what's been going on. So what were kind of the big takeaways for you?
Well, I might just read you through the case and what I thought was most interesting. I think Hai Money putting an emphasis on the contract definitions of an intermediary, and them stating that Finsure kind of understands an intermediary to include an aggregator and a sub-aggregator, not a broker, but Hai Money understanding that term to include broker as well. And their whole argument kind of rested on the case of, well, wrongdoing that has been found at the broker level, not at the Hai Money level. They're separate, and that there's been no. They said there's been no evidence of wrongdoing on Hai Money itself as an entity. Therefore,
because they cited as well that there was an independent report into the compliance checks and they found there wasn't any kind of widespread problems. So I think that's their argument, saying, well, we've already had a look at this, and this report, I think it was from PwC.
PwC, So it heard a report commissioned from PwC into Hai Money's involvement in the alleged fraud, and Finsure commissioned its own independent assessment. And the lawyers summarised the reports as finding no allegations Hai Money was involved in what appeared to be acts of wrongdoing with some of the brokers. They argued the loss of accreditation by some of the brokers, didn't automatically justify bringing down the agreement, and that there had been no allegations against, like I said before, Hai Money personally. So that's their gripe. And a lot of emails were also read out in court, which was really interesting. A lot of it happened to relate to a shift from remediation to termination and how that actually transpired. They kind of argued that in a pretty rapid sequence of time, shifted from what the lawyers were quoted as saying, let's work together to resolve this, to I'm concerned by guilt by association with the brokers whose accreditation have been revoked, which they say pretty suddenly led to the termination of the agreement. And there were also a lot of qualms there about the 30-day notice, but I'm not going to drag the audience down on that one. The listeners
this is good for you, Charlie, for sitting through hours of courtroom arguments between the lawyers.
Some kerfuffles too.
Yeah, of course. Then no one's happy. No one wants to be in the situation, and of course, they have to go through the process. Yeah. But I think there's so many different arguments being laid here. But I mean, at the end of the day, what do they want? They will obviously be keeping you posted as this unfolds, but really interesting seeing that unfold here in Sydney in the courts, and
100%.
having you learn a lot about contract law and corpse law and what's going on behind closed doors. Yeah. And there's a lot more to the case. Obviously Finsure presented their defense as well. That was really interesting, and Finsure's lawyers basically stating that, look, our right to terminate is based on the basis of serious risk and reputational pressure, and them kind of asserting that, well, look, for us to prove that it was necessary to terminate, we only have to prove that broker wrongdoing was engaged by a single broker, they claim. That was the crux of their argument, basically. And they asserted systemic failures on the part of Hai Money. So, it got pretty heated in the courtroom. Lots of allegations being thrown around,
100%.
Left, right, and centre.
Lots of emails and lots of correspondence between the banks and Finsure as well. I think Finsure really fearing reputational kind of the damage that this might create. Featured a lot as well, and them seeking kind of independent advice in the industry as well. A lot of reference to media reports about mortgage fraud. So it's definitely having an impact, I think, this whole ongoing mortgage fraud saga.
Across the board, not just for this aggregation group, but for multiple aggregation
100%,
groups.
that's what I mean. It's profound what's
Moving
happening.
off what's happening at the aggregators, though, we have seen some more acquisitions taking place in the big end of town of the brokerages in different cities. So I spoke to Capita Finance, a WA-based brokerage that is used to be part of Realmark Group, and listeners might know Adam Donald, who we did a podcast with fairly recently about capital finance. But the team there have basically bought it off Realmark. So now it's going to be their own brokerage. They're retaining the brand, I think, from now because capital finance is so well known. But basically, they've bought on the brokers at Capital Finance have bought the company from Realmark, and they're going to be running it on their own terms. And AFG has come on board as an investor as well. So talking about aggregators kind of looking at working the broker channel here, we've seen them already do quite a few investments with their broker investments program. They've taken on a minority shareholding in Capital Finance. So really great to see that kind of thing where brokers are taking back their businesses and kind of, building them and developing them. So if you haven't checked out that story, Adam Donald, I definitely would encourage you to do so. And then Recludo, another company that's been taking up shareholdings and investments in brokerages recently, did its 8th one, I think.
Yeah,
ninth.
Eighth. It stands as the 8th kind of majority acquisition, I think.
And who was
partnership. It was a Victorian-based financial services firm called My Expert, and Recludo has acquired a 51% stake in the company, basically extending that national expansion push, like you were saying before. And
because they've taken investments, as I say, in 7 other brokerages across the country.
Yeah.
So they're kind of taking majority shareholdings and they help them grow.
Yeah, 100%. And they've kind of stressed that it'll remain founder-led. So existing My Expert CEO Brett Waddleton will remain in place. And there was a lot of kind of emphasis put on the development kind of arm of My Expert. And that being that they've got a in-house broker academy. So they think that that's going to have an impact in,
development of brokers.
Yes, they underscored My Expert's industry credentials as well. Has been in the industry for 26 years. He's an MFAA approved mentor. Recludo also talked up this broker academy as well. And he basically went, look, it's going to be a good opportunity for us to train up and coming brokers. There's grassroots educators there, and it'll be a good pipeline for them. They said to get some fresh brokers online and get them writing loans.
I mean, this is really interesting. I think the whole Recludo model, seeing them take majority investments in brokerages. And as we said, AFG's been doing a similar thing. We're seeing lots of companies doing this in the broker channels. It reaches maturation and also looks at kind of being well, how can we take these big brokerages, get to the next level? Because a lot of them have key person risk, or they just don't have the resources or the experience to do, M&A, or to bring on more staff, or to do this kind of academy training type thing. So kind of taking acquisitions and realigning how brokerages are run so that they can grow. Really interesting. And I think CEO Tim Brown has been talking to us a lot as they've been going through this, talking about, why are we doing it? And basically being we want to ensure that brokerages keep on growing and that they have the means to be able to do so. Yeah.
And I think, like Tim said, there's, a lot of challenges that brokerages face, small scale brokerages face as well, whether it be compliance burdens or, just workload and that kind of thing that might prevent them from scaling up to that next stage. And him saying, well, look, we're offering that opportunity to extend those other arms of funding and infrastructure, and, building the network and the kind of, national scale of things as well. We can provide that without disturbing much of the business that you've already built. We'll provide you with what you need. Yeah, basically saying.
Absolutely. So. We'll take a quick break here, Charlie. When we come back, we'll be talking about what else we've been seeing in the landscape, what's happening with rates this year. We've had some changes to forecasts, and we'll get into that just after this message. So there's been so much economic data in the last week come out, obviously with the budget being the big one. There's been RBA movements. There's been, new dwelling figures from the ABS. There's been APRA figures. There's been so much lending figures. There's so much to read. But we've done that all for you, so you are welcome, listeners. And
Head to the website and check out the articles.
Yeah, exactly, if you haven't already. One of the things that took our fancy and piqued our interest this week was seeing not one but 2 different banks revise their cash rate forecasts for the year ahead. So obviously in May, we had another increase. We're now at 4.35%. We're at the same level as we were back in 2020.
5, yes.
February.
Yeah.
So February 2025.
Yeah, before that first hike cut came
Before
in.
the cuts, yeah.
Yep.
So we're back where we were, and there's some expectation that we might have more hikes. The question is when, rather than will they do it. So when do some people think we'll have more hikes?
So obviously we had a flurry of those reassessments of the official rate forecast from the big four banks. The big key points here are that CBA and ANZ predict or forecast that May was the last hike, and now it's going to be extended hold. NAB shifted their perspective. They thought May was going to be the last hike. Now they think that June is going to be the last hike, so they've added one more online. Westpac was always the hawkish outlier when they kind of revised that forecast of theirs a couple of months ago to 3 cash rate hikes. Well, obviously we've already had May. They think there's going to be 2 more. They previously thought there was going to be one in June and August. We've now heard from Westpac, and they've shifted that view, and they think still there's going to be 2 more hikes, but it's
later.
Exactly. They've delayed it. They now think those hikes are going to come online in August and September, so they've delayed it by a month. And they've kind of put this down to the shift in timing down to a couple of things. That being that Governor Bullock in her post decision press conference kind of hinting that, well, look, the current rate gives us space to reassess, to assess how the conflict plays out and the kind of domestic inflationary and economic scenario as well. They kind of took that as meaning, well,
lots of space.
Yeah, we think the RBA is more or less comfortable with the rates that they are for the very short kind of time.
Yeah. So probably not another hike in June.
I don't think so.
August.
Yeah,
which is
August.
the next one after that.
They've pushed it back. And they've revised their official forecast. But they've said, look, it's just a delay here. We're not reducing the amount of hikes. We still think there's going to be 2. But there's a real split now among the banks. There wasn't going into May. They were all certain that it was going to be a hike. Now it's a flurry of opinions.
Yeah, who knows? And I think that's really interesting. They still think there's 2. I would have thought they would have gone later and 1. Just based on the fact that they did seem a bit more hesitant this time round in their commentary, the Reserve Bank says. So I am kind of surprised that they're still saying, yeah, we think there'll be 2 hikes. And particularly given that there's lots of talk about what's going to happen to productivity later this year.
Yeah.
Some people even talking about, would we see a recession?
Yeah.
So I think like having 2 hikes is still a bit punchy.
Yeah, they are the outlier on the market.
And I really hope they're wrong for my own personal
I do too.
mortgage.
For all of those mortgagors out there, I hope it's wrong.
Yes, thank you.
But like you said, why do they think this? What's going on here? They kind of believe that the second and third round inflationary impacts of this conflict are going to be quite catastrophic.
Well, because I think that, and we've been hearing this again from the central bank, saying the ramifications of the Strait of Hormuz being closed has not really been felt yet. So saying it's still, it was still very much the early days because it takes so long for oil tankers to get here. They were like, it really takes about a month for oil to get from the Middle East to here.
Yet,
And it's kind of been open and closed. And we have a lot of oil. So kind of been like the real impacts of this haven't been felt yet. It will take time. So I think the central bank is kind of saying we think the worst of it will come towards the new financial year, like end of financial year, new financial year. And so I think that's potentially, again, why Westpac is saying things are going to get worse. We think inflation will continue to escalate and businesses will have to pass on the costs of price increases to people, which will increase inflation.
Funny you should mention that. I noticed in Lucy Ellis's chief economist at Westpac's commentary, she kind of said, look, the governor might regret saying that. It might bite her moving forwards because, kind of giving the open rein, I guess, although businesses don't need the approval of the RBA governor to pass on hikes.
They have to.
Exactly.
Can't afford it.
Exactly. However, they've kind of said that, well, look, saying that out loud explicitly for them to, well, that's perfectly
gives permission.
reasonable. Exactly.
Yeah. She told me to.
You might regret that when we start to see all those possibly inflationary pressures pop up in construction and groceries and who knows what else.
Fertilizer. And the other big thing, of course, is the budget spending. So being like government spending still going up, and that will also have inflationary, potential inflationary impact. So lots to chat about. Bendigo, I think, was the other bank that had changed their forecasts this week.
Yep.
But they're just saying one more hike.
One more. Yeah, they haven't put a timing on it. They think there's going to be one more from now to the end of the year.
Yeah.
So it could be, at any time, but probably, factoring in the commentary from the major banks sooner than later.
Yeah.
Yeah.
Well, we are also ploughing ahead here at The Advisor with lots of new broker academy preparations because we've got that coming up at the end of the month. So if you haven't yet reserved your free space, it's a completely free event. New broker academies for people really in the beginning of their broking career. It's coming to 3 states, starting in Brisbane on the 28th of May, then going to Melbourne on the 5th, and then finishing in Sydney on the 12th of June. So if you do want to come along and learn what it takes to build a big brokerage, then you can hear from some of the people who have walked the walk and talked the talk, including Bernard Desmond and Nick Riley from Innovate. They're talking about how they've built their businesses, their broking businesses, and how they train other brokers to do the same. We're hearing from lenders about diversification. We're hearing from Daryl Weeks, who you might have heard on the podcast recently, about how to market and use AI to get your brokerage name out there. We're hearing from so many brilliant people actually this year. It's going to be a fantastic event. So if you are interested in coming along, it's free to attend. You just need to register so that we know you're coming and we can get a chair for you. And it's newbrokeracademy.com.au. Whew, I need to lie down. I have been such a massive week this week.
No, it really has.
Cannot get my words straight.
In all honesty,
need to lie down.
It's been ginormous. It's been a ginormous couple of weeks with rates and now the budget. But
budget reply. Oh, so
we don't
much
want
going
things
on.
to cool off.
We love it.
Let them keep popping off.
And so we'll be here for you. If you've got anything that you think we should be covering, do let us know. Charlie Tchetchenian and Annie Kane. You can reach us at editor@theadvisor.com.au. Of course, reach out via email, via LinkedIn, on socials. We're pretty much everywhere.
Yep.
You can leave a comment on the podcast if you want to as well.
Yep, very accessible.
We read everything. So yeah. Let us know if you think there's something that we should be covering that you've been hearing about. We'd love to know all the goss.
Yep.
And we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.